Hello guys, I welcome you to our channel Nota Bene Tech on Tube with our series of quizzes on international accounting standards, and we're going to discuss a quiz on IAS 12 income taxes. The approach that we are following so far is obviously a theoretical and a conceptual approach instead of a thematic approach. So the quiz we're going to test your theoretical and conceptual understanding of accounting for income taxes. That is the International Accounting Standard 12. So let's start with the quiz. Number one question asks us, IAS 12 prescribes the accounting treatment for income taxes and the tax consequences of transactions of the current period that are recorded in an undertaking's financial statements. Yes. The future liquidation of the assets and liabilities that are recorded in an undertaking's statement of financial position. Yes, future is included, and tax planning opportunities. That's not included in IAS 12 about the accounting treatment on income taxes. So only 1 and 2 stands correct, so that's the correct answer. If liquidation of carrying amounts will make future tax payments larger or smaller, IAS 12 generally requires an undertaking to record a deferred tax liability or deferred tax asset. That's a correct option. Permanent differences require provision. No. Deferred tax liability or deferred tax asset, no, because it is for the future, and future is related to the temporary tax differences. And contingent liability, no, none of these is the correct option. Permanent differences require adjustments in only the periods relating to the transaction. You just have to keep in mind, so that's the correct option. So deferred tax assets are the taxes recoverable in future periods in respect of deductible temporary differences, number 1. Yes. Unused tax losses, number 2. Unused tax credits, yes. And taxable temporary differences. Only you have to say that the deferred tax assets are related to the deductible temporary differences and not the taxable temporary differences. So I believe 1, 2, and 3 is the correct option. Yes. Deferred tax relates to deductible temporary differences, unused tax losses, unused tax credits, yes. Taxable temporary differences, yes. Permanent differences, no. It's nothing to do with the permanent differences. So 1, 2, and 3, and 4 is the correct option. If revenue is taxed in the period received, the tax base would be nil. Research and development costs may be expensed in the current period but deductible for tax purposes over subsequent periods. The tax base is the amount of the deduction, is the amount expensed, is the amount of the deduction that can be claimed in future periods. Yes, it has to be for the future period. Okay, we are talking about the subsequent period, so it has to be for the future period. Temporary differences arise, we have discussed earlier, when the carrying amount of an asset or liability differs from its tax base. That's the correct option. A taxable temporary difference gives rise to deferred tax asset, deferred tax liability, either deferred tax or deferred taxable temporary differences give rise to a deferred tax liability. Taxable temporary differences occur when tax is charged in a period. It is taxable temporary differences occur only when the tax is charged in a period after, because it has to be for the future, for the subsequent periods, and it is after the accounting period benefits from the income is after the economic period benefits from the income is recognized in the financial accounts. Deductible temporary differences occur when tax is charged in a period before the accounting period benefits from the income is recognized in the financial accounts. That's the correct option. And differences arising from fair value adjustments are treated differently depending upon whether they arise on acquisition or otherwise. No. Separately for deferred tax, no. The same as any other taxable and deductible differences. This is the correct option. Not all temporary differences are recognized as deferred tax balances. The exceptions are goodwill, yes. Initial recognition of certain assets and liabilities, yes. Certain investment, yes. Property reevaluations, yes. It's 1 to 4 all. Oh, okay, it's 1, 2, and 3 only. So that's one you have to keep in mind. Property revaluations is not included. Okay. The exceptions are okay. So this need to be actually kept in mind. The realization of deferred tax assets depends upon taxable profits being available in the future, accounting profits being available in the future, no increase in the rate of income tax, and that would be the taxable, because you have to defer tax asset. It is the taxable profits being available in the future. When different rates of tax apply to different types of amounts of taxable income, an average rate is used. And an undertaking should review unrecorded deferred tax assets to determine whether new condition will permit the recovery of the asset at each statement of financial position date. So undertaking should review on each financial position date. Okay, see, undertaking for the unrecorded deferred tax asset. Obviously, you have to check the conditions at the annually, so you have to review at each statement of financial position date. And the next question, the carrying amount of a deferred tax asset should be reviewed for changes in tax rates, yes. Changes in the expected manner of recovery of an asset, yes. Changes in future profit, yes. 1, 2, and 3 all. The difference between the carrying amount of a revalued asset and its tax base is a temporary difference. The standards require or permit certain items to be credited or charged directly to equity or other comprehensive income. Examples of such items are: number 1, a change in carrying amount arising from the revaluation of property, plant, and equipment. Yes, an adjustment to the opening balance of retained earnings resulting from either a change in accounting policy applied retrospectively. This is included. And or the correction of an error. IAS 8 has seriously limited this application. Yes, it's true. Exchange differences arising on the transaction of the financial statements of a foreign undertaking. Okay, amounts arising on the initial recovery. That's the third one. Amounts arising on the initial recovery of the equity component of a compound financial statement. That's always true, because you have to take into account the equity. So it will have to be in the equity or other comprehensive income. But let me confirm, it's exchange differences arising on the translation of the third one of the financial statements of a foreign undertaking. I believe so. It's exchange differences arising on the translation of the financial statements of a foreign undertaking. 1 to 4 all. I believe so. It's 1 to 4 all, because 1, 2, and 4 are absolutely correct. There's not a question, and 1 and 2 only are not the is not the correct option. 1 to 4 all. 1, 2, and 3 only is not the correct option, because we have to include the 4, because it is an equity component. So 1 is not only the correct option. So it's 1 to 4 all. Yes, it's been done. So let's see, we have what, 19 out of 20 questions were attempted absolutely correct. or correctly. So we have accomplished what we say a practice mode on international accounting standards. Let's see, it will help us to actually do further on practice quizzes on the remaining standards that we have left with the accountancy and finance. So let's see, we keep on doing it on a regular basis, obviously doing it with some other videos as well. So do keep in touch with our practice quizzes. If you want to ask any questions, you can just put it a comment. You can further share any details with us. We welcome that. And also do subscribe, like, and comment whenever you are and wherever you are, so that you can actually keep in touch with the updates as well. So I appreciate that you went all along with us in this video for the questions. So I appreciate that. Thank you very much for your time. Take care and have a nice day.